We're going to build wealth using two completely different engines and let them run for 20 years to see which comes out on top. Let's set up a fair test. They are the exact same age, they live in the same city, they earn the same salary, and they both have exactly $50,000 saved up. Jake uses his $50,000 as a 20% down payment on a $250,000 rental property. Marcus drops his $50,000 into an index fund, sets a $300 monthly contribution, and forgets it. Right away, Jake feels like he is winning. He has a physical house, a tenant, and a great story for dinner parties. Marcus has a confirmation email in his inbox. When he tells his coworkers he buys index funds, nobody is impressed. But feelings are a terrible way to measure wealth. To find out who made the smarter choice, we have to track the hidden math of time, stress, and liquidity over 2 decades. Looking only at the final number in a bank account ignores the actual human cost, the weekends lost, the sleep sacrificed, required to build that number in the first place. For the first few years, Jake is living the landlord dream. He collects $1,800 a month in rent, pays his $1,330 mortgage, and calculates a neat $470 in profit. On paper, it looks flawless. Then reality hits. That profit margin gets immediately slashed by property taxes, which run about $3,000 a year, plus another $1,500 for insurance. This chart shows what happens when a tenant moves out. The average rental property sits empty about 1 month per year. That is a full mortgage payment Jake has to make out of pocket, with zero income to cover it, wiping out months of cash flow. And that is before the massive, inevitable hits. Water heaters die. Roofs age. By year 5, Jake has paid $1,400 for a plumbing emergency and bought an $8,500 roof. These aren't surprises. They are guaranteed future costs that require thousands in sudden cash. To avoid paying the standard 8 to 10% fee to a property manager, Jake does the work himself. That means screening tenants, fielding 10 p.m. phone calls, and coordinating repairs on lunch breaks. His actual cash-on-cash return hovers around 3 to 5%. Jake owns an active business that requires a continuous trade of weekend hours and emotional bandwidth to maintain. Meanwhile, Marcus has spent 0 hours managing his index funds over the last 5 years. No emergency calls, no leaky pipes, no stress. Yet despite the terrible cash flow and the expensive repair bills, Jake's net worth is actually climbing fast. He is utilizing the single biggest advantage of real estate, leverage. This diagram shows the math behind Jake's initial $50,000. He controls a $250,000 asset. The bank put up the vast majority of the money, but Jake gets to keep 100% of the asset's growth. If that property appreciates at a modest 3 to 4% a year, it reaches $280,000. That $30,000 in total growth belongs entirely to Jake, pushing his equity to roughly $55,000 above his starting point. Marcus is relying on a completely different mechanism. Compound growth is notoriously boring in the beginning, but eventually the gains on his gains start generating more wealth each year than his original contributions. If Marcus wants to scale up, he simply logs in and increases his monthly deposit. It takes 3 seconds and requires 0 additional physical effort. Leverage allows real estate to be highly lucrative with a small starting balance, while the stock market relies on the effortless scalability of compound growth. But Marcus's zero-maintenance lifestyle comes with a massive psychological toll. When the stock market drops, it drops violently. In 2008, the market fell roughly 37%. In March 2020, it dropped 34% in a single month. Watching your $150,000 portfolio shrink to $95,000 in a matter of weeks tests every nerve you have. The data is clear. Most retail investors cannot handle that kind of visceral stress. They panic, sell during the crash, and lock in their losses at the absolute bottom. When Jake has a bad tenant, he can start an eviction. When the global economy halts, Marcus is completely powerless. He has to sit on his hands and rely on emotional discipline to survive the chaos. Furthermore, Marcus's index funds do not provide usable monthly cash flow. Dividends on a total market fund might yield around to his original $50,000 has grown to between $420,000 and $460,000. This chart shows the hidden gear Marcus has access to. If he had bumped his contribution by just an extra $200 a month along the way, his 20-year portfolio would rocket to roughly $600,000. To double his wealth in real estate, Jake can't just tweak a number on a screen. He has to save up for another down payment, sign a new mortgage, and literally double his physical workload by managing a second property. They both reached the $500,000 finish line, but their journeys demanded completely different things. Jake had to work a second job to earn his wealth. Marcus just had to wait for his. The right choice isn't about which asset is objectively better. It's about which asset fits your specific capacity to handle stress, labor, and time. This flowchart breaks down the ultimate dividing question I have to answer. What is your most scarce resource right now, your time or your capital? If you are short on capital but have the time and drive to run a hands-on business, real estate is incredibly powerful. You can use sweat equity to force appreciation, tap into bank leverage, and unlock significant tax benefits. But if your days are already packed and you prioritize complete liquidity and zero maintenance above all else, index funds are the clear winner. You trade maximum leverage for total freedom. The greatest financial risk you can take is choosing an investment based on a flashy headline without calculating the brutal 20-year reality of what it will actually demand from your daily life.